Hello everyone, in this session, chapter A1.1 Accounting and its Environment will be covered. Under this module, I will begin by defining accounting in simple terms so that everyone clearly understands what it means and why it is important. After that, I will focus on the accounting environment, which includes the institutional, legal, professional, social and technological factors that shape how accounting works in practice, both globally and in Bangladesh. This will help you understand not only what accounting is, but also the environment in which accountants operate. Finally, I will move on to explain the different branches of accounting, such as financial accounting, management accounting, and cost accounting, so that you can see how accounting serves different purposes in different contexts. So first issue is the definition of accounting. Accounting is the systematic recording, reporting, and analysis of financial transactions of a business. It records, stores, sorts, retrieves, summarizes, and presents the information in various reports. Based on the above discussion, we may define accounting from conceptual and operational perspective. Conceptually, accounting is often described as the language of business. If a business entity wants to let others know about its condition and status, the entity must communicate with numbers, for example, profit of the business or total value of assets. The numbers are generated or produced through accounting. Thus, a business uses accounting as a means of communication. On the other hand, operational definition defines accounting as an information system. Accounting starts with keeping a book to record transaction data. These records are used to produce meaningful information that possess certain qualitative characteristics. The steps in accounting cycle are similar to what an information system does. Thus, accounting is called an information system. So, in comprehensive form, we can define accounting as an information system that identifies, records, classifies, and summarizes the transactions of an entity and provides information through preparing the financial statements so that interested users can make their economic decisions. As I have mentioned here, accounting records transactions. So, the question is, what is transaction? An event of an organization is considered as a transaction of a business when it has a dual effect or two parties, measured in monetary value and change in financial condition. If you look at the chart, you will find that transaction of an entity works as an input of this accounting information system. The identified transactions are then recorded, classified and summarized as part of the processing stage, and finally as output, the different financial statements are prepared and shared with the interested users so that they can make their economic decisions. Okay, now the question is there any difference between accounting and bookkeeping? The answer is yes, there are some differences. Bookkeeping includes identification of transaction and recording transaction in a journal, but accounting has a broader aspect because accounting includes identification of transaction, recording the transaction in a journal, process recorded data, analyze business data and information, and then prepare reports for the interested users. Then we have to know about business and its categories. A business can be defined as a commercial organization that is established with the primary aim of earning profit. It involves producing goods or providing services to satisfy human needs, while also creating value for the owners. In terms of ownership, there are different categories of business. The scale of activities of this type is naturally different, and thus the job of an accounting varies from one type of business to the another one. The different categories of business are sole trader business, that is, this is a business that is owned and operated by one person. He or she is solely liable for all business debts, but when successful, takes all the profits. Partnership business. This type of business is owned by several individuals, some of which will actively be involved in the business. Then companies business or corporations. These types of business is owned by the shareholders and is operated on their behalf by a nominated board of directors. Non-trading organizations or non-profit corporations. For example, clubs, associations, and other non-profit making organizations are normally run for the benefit of their members to engage in a particular activity and not to make a profit. Their financial statements will take the form of income and expenditures accounts only. And another form of business may be cooperative society, a legally constituted business entity formed for the explicit purpose of furthering the economic welfare of its members and that of the wider society by providing them with goods or services. So, our next topic is accounting framework. Under this section, first of all, I like to explain the concept gap. GAAP is a set of accounting principles, standards, and procedures used to prepare and present financial statements consistently. It ensures that financial information is reliable, comparable, and understandable for users such as investors, creditors, and regulators. It covers rules for revenue recognition, asset valuation, expense matching, and disclosure requirements. GAAP as a concept exists worldwide. Different countries have their own versions of GAAP, often aligned with international financial reporting standards. Accountants operate in a dynamic environment influenced by various factors. These factors share the accounting practices in a country. The factors are economic factors, for example, inflation, trade, investment climate, taxation policies. Then legal and regulatory environment, for example, Companies Act, Securities and Exchange Rules, IS, IFRS, central bank regulations, like these things. Then technological environment, use of accounting software, digital payment, automation. Cultural and social environment includes ethical standards, societal expectation regarding corporate transparency. And international environment includes global trade, cross-border investment, IFRS compliance, FDI inflows. So the accounting environment of a country is influenced by laws, professional standards, economic and political factors, and technology. A strong accounting environment ensures reliable financial reporting and builds trust in the economy. Globally, many countries have their own accounting standard setting bodies. For example, in Japan, the name of the standard setting body is Accounting Standards Board of Japan. In Germany, German Accounting Standards Committee works as an accounting standard setting body, and in USA, Financial Accounting Standards Boards. These standards may be principle-based, rule-based, tax-oriented, or business-oriented, so they differ in approach and objectives. To bring harmonization and improve comparability, the International Accounting Standard Board, based in London, issued the International Financial Reporting Standards. These IFRS are widely used globally and provide a common platform for companies to report and for investors to compare financial information across countries. To introduce the accounting and auditing standards, different professional accounting organizations play crucial roles around the world. Some of these organizations are International Federation of Accountants, South Asian Federation of Accountants, the Confederation of Asian and Pacific Accountants, American Institute of Certified Public Accountants, Chartered Institute of Management Accountants, Institute of Management Accountants, Institute of Chartered Accountants in England and Wales, the Institute of Chartered Accountants of Bangladesh, the Institute of Cost and Management Accountants of Bangladesh. In addition, the accounting environment of any country is also influenced by multiple factors such as statutory requirement, professional technical competencies, political and economic requirements, social and cultural requirements, and technological requirements. And our next topic is accounting environment in Bangladesh. In Bangladesh, the Institute of Chartered Accountants of Bangladesh was historically responsible for adopting IFRS and regulating accountants. However, with the introduction of the Financial Reporting Act in 2015, the Financial Reporting Council has taken over these responsibilities. The FRC now set accounting and auditing standards in line with international practices. ICB, meanwhile, continues to play an important role in educating and training professional accountants. The regulatory framework of accounting practices in Bangladesh include the following. Financial Reporting Act 2015 established FRC as sole authority to adopt and enforce IFRS and IAS. Companies Act 1994, this is a statutory reporting for all the registered companies. Bangladesh Securities and Exchange Ordinance 1969 and Rules 1987. These rules requires listed companies to submit IFRS compliant financial statements. The Bank Companies Act 1991. This is the primary legal framework regulating banking companies in Bangladesh. The Insurance Act 2010, and this is the main legislation regulating the insurance sector in Bangladesh. Then NBR tax laws, and these laws affect financial reporting for tax purposes also. In addition, Bangladesh Bank and Insurance Development and Regulatory Authority also help in developing accounting standards or accounting practices in Bangladesh. So our next issue to discuss is the branches of accounting. When we talk about accounting, we usually think of financial statements or profit calculations. But in reality, accounting has different branches, each serving a unique purpose. The three main categories are financial accounting, management accounting, and other branches. So first, I shall define what is financial accounting. Financial accounting is the process of identifying, recording, classifying, and communicating financial transactions of an organization in accordance with recognized accounting standards, with the objective of providing useful financial information to external stakeholders for decision making. The main objective of financial accounting are to systematically record business transactions, determine profit or loss, show the financial position, provide reliable information for decision making, ensure compliance with standards, and facilitate comparison over time and across entities. The stakeholders of this accounting includes two groups, external users and internal users. External users include investors and shareholders, creditors and lenders, regulatory bodies, suppliers and trade creditors, customers, government and tax authorities, and public and financial analysts. And internal users include managers and employees. Next, what is management accounting? Management accounting is the process of identifying, measuring, analyzing, interpreting, and communicating financial and non-financial information to managers for planning, decision making, and controlling organizational activities. The main objectives of management accounting is to provide relevant and timely information to managers for planning, controlling, decision making, cost analysis, variance analysis, and improving organizational efficiency and performance. As I have already mentioned, the purpose of using management accounting information are planning, decision making, controlling, performance evaluation, and resource allocation for ensuring optimum use of funds, manpower, and other resources. So there are some differences between management accounting and financial accounting. Financial accounting deals only with the historical data and with few estimations to present the true and fair view of the business for a period concern. On the other hand, managerial accounting is decision-oriented and such focuses on the future. It only considers relevant information and concerns about a segment of a firm. There are some other branches, for example, cost accounting. This branch may consider as the sub-branch of managerial accounting. The central focus of this branch is to manage cost for optimum utilization of resources. Tax accounting. Tax accounting mainly concerned about proper tax planning along with the compliance of regulatory requirements in this regard. Another accounting is forensic accounting. This branch focuses on the legal affairs, for example, fraud investigation, legal cases, dispute resolutions, etc. Fiduciary accounting. This focuses on the administration and custodianship of properties. Non-profit accounting. This accounting especially for not-for-profit organizations. Then government accounting. This branch concerns about the allocation and use of government funds. And then social accounting. This concerns about the impact of an organization on the society and its environment. Sustainability and environmental accounting. This sustainability or environmental accounting are linked to the GRI standards and IFRS S1 and S2. That's all for today. Keep your curiosity alive. We will dive deeper next time. Thank you.